Gold just hit $5,171. Silver just dropped 4% in a single session. And right now, millions of precious metals investors are staring at their portfolios asking the same terrifying question. Is this the beginning of the end? Or is this the opportunity they've been waiting for? Before you make any decision with your money, you need to hear this. So in this video, we're going to separate what's real from what's just hype. By the end, you'll walk away feeling calmer, clearer, and far more confident about what you're actually buying, and more importantly, why you're buying it. Drop a comment below and let me know the exact day and date you're watching this from. I love seeing where and when you're tuning in. And real quick, if you appreciate content that's built from scratch, thoughtfully researched, and never copied, support the channel by subscribing and commenting Henry's Market HQ below. It helps this channel grow more than you think, and I truly appreciate it. There is a number that most financial news anchors mentioned once and then moved on from, but that number deserves a lot more of your attention than it got. When gold crossed $5,171 per ounce, following the release of the latest U.S. jobless claims data, it wasn't just a price milestone. It was a signal, a very specific kind of signal that the precious metals market sends when something deeper is shifting in the global economy. And the fact that silver simultaneously dropped 4% in a single trading session didn't contradict that signal. It confirmed it. To understand why, you have to understand the relationship between gold, silver, and the labor market data that just moved both of them. And that relationship goes back much further than most retail investors realize. Let's start with the labor market. The jobless claims report is one of the most closely watched economic indicators in the world. Every week, the U.S. Department of Labor releases data on how many Americans filed for unemployment benefits for the first time. When that number comes in higher than expected, it signals weakness in the job market. When it comes in lower, it signals strength. But here's what most people don't think about. The Federal Reserve is watching that same number, and they are watching it for a completely different reason than you are. The Fed uses labor market data to calibrate its interest rate decisions. A weakening job market gives the Fed cover to cut interest rates. A strong job market makes rate cuts harder to justify. And interest rates are the single most important lever in the entire precious metals equation, because gold and silver don't pay dividends. They don't generate cash flow. Their value is measured in large part by what you give up to hold them, and what you give up is determined by interest rates. When rates are high, the opportunity cost of holding gold and silver is high. When rates fall, or are expected to fall, gold and silver become far more attractive relative to bonds and savings accounts. This is why gold surged to $5,171 after the jobless claims data dropped. The market read weakness in the labor numbers and immediately began pricing in a higher probability of Fed rate cuts later this year. Gold responded the way it always does when rate cut expectations rise. It moved up, fast and decisively. That part of the story is straightforward. The part that's throwing people off, the part that sent silver investors into a panic, is why silver didn't follow gold higher. Instead, it fell 4%. And that divergence is where this story gets genuinely interesting. Silver is not purely a monetary metal. It is also an industrial metal. Roughly 50 to 55% of all silver demand globally comes from industrial applications. Solar panels, semiconductors, electric vehicles, medical devices, and a growing list of green energy technologies. This dual identity is silver's greatest strength over the long run, but it is also its greatest source of short-term volatility. When economic data comes in weak, as it did with these jobless claims numbers, industrial demand expectations fall, manufacturers pull back, supply chain orders slow, and the industrial side of silver's price story gets hit hard, even when the monetary side is benefiting from the same economic data. So what you saw in that single session was two forces pulling silver in opposite directions simultaneously. The monetary tailwind from rate cut expectations pushed silver up. The industrial headwind from economic weakness pulled it down harder. The net result was a 4% drop, and a lot of frightened investors who didn't understand what they were actually watching. Here is the number you should have been watching instead of the daily price move: the gold to silver ratio. At the time gold hit $5,171, the gold to silver ratio stretched to historically elevated levels, well above 80, which is a threshold that has historically preceded major silver outperformance over the following 12 to 24 months. The gold to silver ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. When that ratio is high, silver is historically cheap relative to gold. When it compresses back toward its historical average, which has oscillated between 40 and 60 over long market cycles, silver investors who bought during the high ratio period tend to outperform gold investors significantly. This is not a theory. This is a pattern that has repeated across multiple economic cycles, and right now, that ratio is flashing one of the loudest signals it has sent in years. The investors who panicked and sold their silver during that 4% drop did not understand this ratio. They saw a red number on a screen and they reacted emotionally. That is understandable. Fear is a powerful force, especially when your money is on the line. But emotional reactions to short-term price moves in precious metals are almost always the wrong move, and the historical data backs that up consistently and without exception. If this is making sense so far, go ahead and hit that like button. It genuinely helps this channel reach more people just like you. Now here is where the analysis needs to get more precise, because there is a layer to this story that almost nobody in mainstream financial media is talking about, and the silence around it is telling. When gold makes a major new high, especially one driven by labor market data and rate cut expectations, there is almost always a shakeout in silver before the broader precious metals rally continues. This is not a coincidence. It is a pattern, and it is a pattern that institutional traders understand and, in many cases, deliberately exploit. Think about how the market actually works at the institutional level. Large funds, trading desks, and algorithmic systems don't just react to news, they position ahead of it, and then they manage their risk in ways that create specific price patterns in highly liquid assets. Silver, despite being a smaller market than gold, is liquid enough for institutions to use as a risk management tool. When gold makes a sharp move higher, institutions that are long both gold and silver will often reduce their silver exposure to lock in profits, rebalance their portfolios, or free up capital for other positions. This selling pressure hits silver hard and fast, especially in a single session, and it creates exactly the kind of dramatic 4% drop that scares retail investors into selling at precisely the wrong moment. This is where most people stop reading, stop watching, stop paying attention, but the ones who stay are about to understand something that could completely change how they see their money. What institutional selling in silver actually represents when it follows a gold breakout driven by macro fundamentals is not a rejection of silver's value. It is a reset, a clearing out of weak hands that historically sets the stage for silver's next leg higher, and the next leg higher, when it comes after this kind of shakeout, tends to be violent in speed and significant in scale. The historical data from previous precious metals cycles, including the 2008 to 2011 cycle, the 2018 to 2020 cycle, and the more recent moves, shows a consistent pattern. Gold breaks out first, silver lags and often pulls back sharply. Then silver catches up and in many cases overtakes gold's percentage gains by a wide margin. The investors who made the most money in precious metals over the past 2 decades were not the ones who bought silver when it was exciting and the headlines were positive. They were the ones who bought silver during the scary sessions, during the 4% drops, the panic headlines, the moments when retail sentiment was at its worst. Now, let's talk about the specific price levels that matter right now, because watching levels is not just a technical trading exercise. Levels tell you where the market's conviction is being tested. For silver, the level to watch on the downside is the zone that served as resistance before this most recent run began. When a former resistance zone becomes support, it tells you that the market has genuinely accepted a higher price range. If silver holds above that level during this pullback, the structure of the move remains intact. If it breaks below it with volume and closes there on a weekly basis, that changes the picture meaningfully, and you need to know that before you add more to your position. For gold, the critical level is the breakout zone it just cleared, the area just below $5,000 that the market had previously struggled to hold above. If gold retests that area and holds, it will be one of the most powerful technical confirmations this market has produced in years. If it fails to hold, the short-term picture becomes far more complicated, and the macro thesis needs to be reassessed with fresh eyes. The labor market data that triggered this entire move is also not a one-time event. Jobless claims come out every single week, and the trend in that data over the next 6 to 8 weeks will either reinforce or undermine the rate cut narrative that is currently driving gold higher. A single week reading is a data point. 3 or 4 consecutive week readings become a trend. And when the Fed starts responding to a trend in the labor market, that is when precious metals markets tend to make their most dramatic and sustained moves. You are not in the wrong investment. You may simply be in the wrong time frame. Most retail investors make the mistake of measuring long-term assets by short-term price moves, and that mismatch between the asset's nature and the investor's measurement window is responsible for more wealth destruction than almost any other single factor in personal finance. The pattern being set up right now in gold and silver is one that historically rewards patience, conviction, and the ability to hold through the exact kind of volatility that just shook out a significant portion of the retail investor base. That is not a comfortable truth, but it is an honest one. An honest analysis is the only kind worth your time. Here is the resolution you came to this video for, stated as clearly and directly as possible. The 4% silver drop you just witnessed was not a breakdown. Based on the macro environment, the gold to silver ratio, the institutional trading patterns that consistently precede major silver moves, and the labor market data now pointing toward a higher probability of Fed rate cuts, this pullback carries the characteristics of a shakeout, not a structural reversal. That is not wishful thinking. That is pattern recognition built on historical data across multiple cycles, and it deserves your serious attention. So what do you actually do with this information? The first thing you do is define your levels before you make any move. Decide in advance where you would add to your position if silver continues to pull back, and decide where your thesis is invalidated. The price level that, if broken on a weekly close, tells you the market is telling you something you didn't expect. Having those levels defined before the emotion hits is what separates disciplined investors from reactive ones. The second thing you do is look at your time horizon honestly. If you bought silver as a 90-day trade, this environment is difficult and you should manage your risk accordingly. If you bought silver as a 2 to 5 year macro position based on the rate cycle, the dollar's long-term trajectory, and the industrial demand story, then a 4% pullback is not relevant to your thesis, and acting on it emotionally would be a mistake that you would likely regret when the rally resumes. The third thing you do is pay attention to the Fed's next move and the trend in jobless claims over the coming weeks, because that data is the engine of this entire trade. If the labor market continues to soften, rate cut expectations will increase, the dollar will face downward pressure, and gold and silver will have a fundamental tailwind that no amount of short-term volatility can permanently override. You don't need to predict the exact day that happens. You just need to be positioned correctly and have the patience to let the macro thesis play out. I want to be clear. I'm not here to sell you anything. I'm here because this information changed the way I think about money, and I want it to do the same for you. The precious metals market is confusing, volatile, and emotionally exhausting in the short run. But when you understand the forces driving it, interest rates, labor market data, institutional positioning, and the gold to silver ratio, it becomes far less frightening and far more navigable. You stop reacting to red numbers on a screen and start seeing the larger picture that those numbers are painting. That shift in perspective is worth more than any single trade because it protects you from making fear-based decisions that destroy long-term wealth. The investors who built real financial resilience through precious metals did not do it by predicting every price move correctly. They did it by understanding the macro environment, managing their risk with discipline, and staying committed to a thesis that the data continued to support. Right now, the data continues to support this thesis. The shakeout you just watched may be uncomfortable, but discomfort in investing is almost always the price of meaningful returns. And the investors willing to pay that price, with clear eyes and a grounded understanding of what they own and why they own it, are the ones who look back on moments like this one and recognize them for what they were, an opportunity hiding inside a panic. If you are benefiting from our topics, please subscribe, like, and turn on the bell notification so you can see our new videos early.